we're going to walk through how the deal analyzer works. And the deal analyzer has 5 tabs. Tab number 1 is welcome and resources. Tab number 2 is going to be the property and equity details. Tab number 3 is going to be the rent and the rent comparisons, the rent comps. And tab number 4 is going to be the financial P&L information, the profit and loss information. This is also known as your T12 information you'd get from the broker, right? And then tab number 5 is going to be your investment returns.
So the first tab, right, the welcome and resources tab, this is just kind of a welcome and you know, all the helpful links that we find, you know, really good for when you're doing these analyses. We've got rent comparison tools. There's a website where you can look up loan interest rates. There's a website that's got some information on cap rate research, right? So what are the cap rates in the markets that you're looking at? You can look at crime in the area. It links to Google Maps. You can go on the Street View and start browsing around the area where your property is located. And I've also got the broker portals direct linked here as well. So it's all a nice, helpful, you know, set of links all in one place. It's the same broker portal links that are in the section 2 where we go through how to use the broker portals, but we've got them all right here so you can go through them, you know, quickly. Then I've got a glossary of terms down at the bottom. So if you're kind of going through the template and you find a section where you don't know what a term is or just want to look something up, we've got all the major ones listed down there, so you can always reference back to the welcome and resources tab. So the first tab after that is the property and equity details. And this is where you start to enter a lot of the basic information about your property. You start entering in the bank loan information and then the renovation information and the exit strategy. So the property and equity details, you're going to start off with just the very basics, right? How many units does the property have? What's the asking price? And what's the purchase price? You've got a per unit calculation right below those items. I always like to throw in here the property name. I put in the property address just for quick reference. And then I usually like to just throw in there a picture of the property, just so when I go back and kind of, you know, quick reference, what did the property look like, you know, when I'm looking at the financials as well. So we've got earnest money deposit, right? So that's the money they're going to have to, you know, include as your deposit when you're putting a deal together for the property. We've got your acquisition fee, right? That's your percentage that you're charging for the GP in order to put the deal together and to be compensated on the front end when that deal closes. And you'd enter those numbers in there. You enter your acquisition fee as a percentage. And then if you're doing a member equity split versus the GP split versus the limited partner split, this is where you'd put your percentage. If you're offering a preferred return, that's where you put your percentage right under that. And then you've got a section for asset management fee, right? So this is the ongoing asset management fee for the general partner. So you'd enter that as your percentage there. Then for working capital, right? That's your day-to-day funds, your kind of your liquid day-to-day operating funds. How much you're going to need for the property, you'd enter that dollar value in the working capital field. Then I do have a section just for, you know, general notes that anything that comes into my mind while I'm looking at a property, I would jot down there, right? So you can kind of keep all your notes in one place. And then there's a calculation over on the right-hand side in the middle that talks about, you know, your manager equity percentage. That's just the difference between your member equity and the total, right? The difference in that percentage, that's your split, right? If that's 70-30, your manager equity would be 30% there. It calculates out the dollar value of your acquisition fee, right? You input the percent, but it'll give you the dollar value there and your earnest money as well. Now, the last line up here is the total equity needed for investment, right? That's an important line there because that's what's going to be your money raised at the end of the day, right? This is going to be the money that you need in order to close the property, right? This is all the funding that you're going to need to raise. So what's included in that is the down payments, right? Including any earnest money deposits, the closing costs, right? All the money that you have to pay to the bank for the title and for all the rest of the closing costs go into there. Your acquisition fees, right? That's all part of your money raise, right? That's how you compensate the general partners for putting the deal together. You have the option to include the repairs or renovations, right? You can raise money for that, or you can finance that. Either way, you're going to need money for fixing up the property. Your working capital contingency, right? So the day-to-day liquid funds that we talked about, what you need for your day-to-day operations. You'll need to raise that and have that available when you actually do close the property. So this is kind of just a breakdown of what goes into that line. But yeah, these are all the things you'll need to think through and have ready for closing. And then we get to the mortgage and loan strategy, right? So we're going to need loans for these properties, right? We're gonna pay 100% purchase price. We're going to use other people's money, and part of that other people's money strategy is the bank loan, right? So you've got choices here. The first choice is what type of loan, and kind of the two choices we've got in the template are the standard conventional and a bridge loan. And your bridge loan is going to be for situations where the property is not very stabilized, or it's coming from a state of disrepair, right? Where you're going to have to do a lot of construction to get some down units back online, something to that effect, right? That's where you want to pick your bridge loan. It's going to come with a higher interest rate, and it's going to be kind of a shorter term loan, and you're going to want to refinance it eventually. But if that's not the case, you can go with standard conventional. And in either way, you're going to want to input your down payment percentage, your interest rate, all your terms of your loan, right? So what makes up the loan? Amortization years, interest only months, right? So if you're going to be using interest only, that's a good way to minimize your costs in the first couple periods, if it's available, right? Some banks allow you to only pay interest payments for the first year or so. And if that is an option, then it's going to help out your cash flow, obviously, in that first period. Then you've got an option to finance your closing costs, right? So, it's going to be, a sizable chunk of change. You can either raise it as part of your money raise, or you can finance it as part of the loan. So that'll be an option. And then kind of getting back to the theory of refinement, right? So you've got the option here to use a fixed percentage for your closing costs, or you could detail them out individually. Obviously, eventually, you're going to want to detail them out individually if you are serious about the property and you do want to pursue it. But right off the bat, I recommend just using a fixed percentage, right? That way you can, not spend 2 hours breaking out closing costs on a property that you don't like anyway. So I'd recommend going with the fixed percentage first and then refining it to the detailed line items later. And we've got in the green text off to the side just the rules of thumb for what these closing costs typically run. Obviously, you want to confirm those once you get to that level of detail with your bank. All right, also on the property and equities details tab, renovations and exit strategy, right? So obviously, once you take this property over, we're gonna be doing some renovations, right? We're gonna be making it better. So this is where you plan out the costs for those renovations. And you can put them all in one line if you've just got a very high level number. You can put them all in light rehab, right? But once you get further on down the road, you're going to want to get detailed, your detailed quotes from your vendors, and you want to put that information into this template here, right? You're going to get more specific eventually. And then you also have the option for your renovation costs if you want to include them in the loan, or if you want to do a money raise for those costs, right? That's where you'd select from that drop down on the right-hand side, the yes or no. Then when you get to exiting the property, right? So at the end of the day, right, we want to exit this property when we want to get our investors the returns. You're gonna have to pick between selling the property or refinancing the property, right? And you're gonna want to pick that drop down depending on what you want to do. You're also gonna want to pick a time frame, right? So you're gonna hold on to the property for 4 years, 5 years, 6 years, 2 years, whatever that time frame is, whatever your investment time frame is, that's what you put down in that exit year. Then you've got to consider what is the cap rate going to be at that time of exit, right? What's your market cap rate now, and what do you think it's going to be doing over the next 4 or 5 years? This is an area where you don't want to be too aggressive, right? You don't want to go in really hot with a low cap rate, and you think we're getting all this cap rate compression. You want to leave yourself a little bit of conservatism in that cap rate, right? Just in case the market goes against you or whatever happens, right? So that's kind of a big potential pitfall is if you end up going too aggressive on that exit cap rate. So definitely something you want to kind of keep in consideration as you're running through this. We've got a section for disposition fee. We don't usually charge that, but if you do charge an exit disposition fee once you dispose of the asset, then you can put that percentage there. Same thing for the cost of the sale, right? Your fee to the brokers and any other closing costs on the seller's end, right? You put that percentage in there. And if you've got a prepayment penalty, right? And what that is if some bank loans, they've got a penalty if you are to repay the loan early, right, before its full term is lived out. If your loan has that type of clause in it, you'd want to put that dollar value in that box. So that'll detail out some of the property and equity details, some of the high level basic information, and then getting into some of the renovation and exit strategy. Then after that, you get into your rent and comp information, right? So we've got two rent models to pick from. One rent model is called a rent escalation model, and the other one is just kind of your standard model, right? So you either select it using a yes or a no. If you pick yes, that means you're using the rent escalation model. And if you pick no, that means you're just going with the standard vanilla model. And the difference between the two is in the rent escalation model, you get to pick the number of units that you're going to renovate, and then you get to put in the number of renovations that you're doing per month. And the file actually scales in the costs, the price increases as the time goes on, right? So if you're doing 2 units per month, the file is going to scale in your additional profit for 2 units per month as they complete, right? So you can kind of scale in your profit increases over time versus the traditional model. You kind of have to manage that through your vacancy. When you actually go to put the dollars into the template, right? So you've got a description over on the left-hand side. That's where you put in your information for how many bedrooms and bathrooms the units are, kind of your description for what the unit is that you're looking at, right? So if it's a 1 bedroom, 1 bathroom, and you've got 30 of those units, and they're 1 bed and 1 bath, right? And then what's the square footage of those units? And then what's your T12 dollars per unit, right? So what's your current rental rate on those units? That's how you kind of fill out that information. And then on the right-hand side, you get to your pro forma rent, right? So that's going forward. What does your rent profile look like? So you start off with your unrenovated current market rent. So if you didn't do anything to these units, what is the market rent for them right now? And then we kind of talked about, how many units are you going to increase the rent for? And that could be due to renovations or just rent bumps, right? You're just increasing rents because you think the area can support it. And then you enter your per unit rent increase. So if you're starting from an unrenovated market rent of $700 and you think you can get to $750 after renovations or $800 after renovations, you put your extra $50 or $100 into this per unit rent increase box. So that's the amount of rent that you're increasing per unit once you complete renovations or increase rents. And then once again, your renovations per month is how many renovations that you think you're going to be able to complete each month. If you're going with the traditional model, it's pretty much the same on the left-hand side, but on the right-hand side for the pro forma, you're just putting in your unrenovated current market rent and then your after renovations market rent, right? So you're just doing that two-sided comparison there, right? So if you're going from 700 to 800, you put 700 in the left-hand side and then 800 in the right-hand side. Now, the last piece of this model is the organic market growth, right? So, based on inflation or market forces or general, more employers moving into the area, right? Or less employers moving in and people leaving, right? Your market's going to be either growing or shrinking. Your market rents are going to be going up naturally aside from all the efforts that you're undertaking. So the percentage growth for what you expect that to be is what you're going to put in the top blue boxes for this section, right? So if you think your market growth is going to be 2% every year, you would just put 2% in those blue boxes up top. So that's how you fill out the rent and comps tab, or at least the rental portion of the rent and comps tab, right? This is an important section because it's going to drive a lot of the profitability coming off your property. You're going to want to be looking for your properties that can sustain a decent sized rent increase. The comps portion is where you start to think about, what are the comparable properties for this property that you're looking at, right? So, it's good to have an idea of what the rents are in the area and what you want the rents to be. But at the end of the day, you want to validate that, right? You want to look around and see what other properties that are really similar to your property are charging. So this is where you put that information in, and how we do it is. You start off with just a property name. This is for your comparable properties now, not the property you're looking at. This is when you're going on, and we'll in a later section, we'll show you our rent comparison tool that we use to look for these comparable properties. But here's where you kind of stack them up and analyze them versus your target property, right? So I like to just kind of put some pictures in here so I can remember what my comparable property looked like. And, ideally you want your comparable properties to be as close to your target property as possible, in size, amenities, quality, everything. You put those pictures in there. I put them in there just so I can, remember what they looked like. I always put the property address and name up in this top property name box. And then I input the price and the square footage for the comparable unit that I found, right? So if I'm charging $800, if I think I can charge $800 a month for a 1-bedroom, 1-bath unit, and I found a comparable, and that is $810 a month, right? So I'd put that $810 in that dollar sign bucket, and then I've put the square foot in the square footage bucket, right? So that way it'll calculate for you a dollars per square foot for all of your comps by unit, right? And in the left-hand side on this tab, you've got your comparable properties averages, right? So at the end of the day, once you've inputted all your comparable properties, and you can see, okay, for all these properties that are really close to my target property, I can see what the dollar values are per square foot, and I can see if my assumptions for my property that I'm looking at, I can see if they're reasonable based on the market price, right? If my dollars per square foot are pretty close to what these other properties that are a similar similar quality and similar amenities, then I think I'm on the right track here. That's how you start to sanity check some of your answers. But as far as putting the numbers in the spreadsheet, right, that's how you do it for this section. Next, you get to your financial P&L, right? So for income, you'll notice this closely mirrors some of the line items that you might be familiar with from your T12, right? So I always like to start with inputting the T12 numbers all the way on the left-hand side. So this is straight off the T12, no variations. Just put it in exactly as it is because that's your starting point, right? Put in all your line items for income, all your line items for other income. And then, for the forward projection, you've got years 1 through 10, however many you need, right? If you've got an exit year coming up in year 4, 5, or 6, once you populate that into the template, it'll highlight that column, so you can always keep track of what year you're actually exiting in. Then you'll want to continue to populate all the forward-looking data once you've got your T12 starting point in there, right? And up at the top, you've got your section where you can apply your percentages that are going to kind of apply to a lot of the growth lines on the rest of the worksheet. So what I mean by that is if you're looking at your vacancy, right, you would want to input your percentage vacancy for each year. And the same thing for the loss to lease, right? So wherever you think your vacancy is going to be for year 1, if you think it's going to be 10%, then you put a 10% in that vacancy box, and it's going to automatically calculate down below the appropriate dollars to take out of your gross potential rent to get to your vacancy level of 10%. And same thing for loss to lease. You would enter that as a percentage in year 1 as well, and that would back off the appropriate dollars down here in the financial section. So you'd input that for every year that you're going to hold the property, and then you'd also get down to notice that your rent is actually pulling from the rent tabs that you just completed. So once you're done with those rent tabs, you don't have to touch it again on here. Then you've got your other income, right? So all the activities that you're doing aside from the rent that's going to generate income for you, pet fees, parking fees, any other fees for applications and non-payment and slow payment, anything like that, you consider as other income, right? And that's where you'd put it, is in these other income lines. And you'd also select a growth rate up top for how as a percentage, how quickly you think that other income is going to grow. So that's what you'd populate in the other income growth section. And then in the expense growth section, it's the same idea, right? So how quickly do you think your expenses are growing? So, typically you want to take inflation and your area into account when you're coming up with those growth rates. After you go through your income, you'd come through and populate your expenses, right? So same idea. You start with your T12 as listed, no changes from the T12, and then your year one and forward, right? So your year one, you would enter the exact dollar values that you think you're going to be at, and your years 2 through 10 are all populated based on your growth rates that you entered back in the top section, right? So if you entered a 3% growth rate and you entered, your dollars in year one, your year two should grow 3% from that level. You've got your total expenses down below. And then you also have your net operating income, which is going to be obviously your income less all your expenses. And that's going to be your net operating income at the end of the day, right? That's how your property is going to be valued. So a very important line, right? We've also got lines on here for your debt service, right? So how much money are you going to be paying to the bank each year, right? That's you got to pay the bank before you distribute any money to investors. So got to keep an eye on your debt service, right? As well as your debt coverage ratio, right? So that'll be calculated right down here as well. And then you do have for management fee, you enter a percentage over here. So it'll just calculate all your lines as that percentage. And same thing for, or similar for the reserve, your capital reserve line. So this is the dollars that you want to reserve every year to put into your capital reserve funding for potential issues with larger, harder to repair items. If you run into an issue where you've got, some HVAC work that you have to do, right? If it's a significant component of your HVAC was damaged, right? You've got a capital reserve to cover that. And that's where you want to put a per unit annual reserve in that line. Returns. Yep. So after you've calculated all of your profit and loss data, this is where you get to your investment returns, right? And this is all going to self-populate, right? So once you've done all the work on the rest of the spreadsheet, this will kind of just be your answer section for the most part. It's going to start with your net operating income. It's going to pull right from the previous section, and you can start to look through how your investor returns are stacking up, right? So you can see what the investors had to initially deposit into the capital account, your money raised from investors. You can see, how the cash flow after debt service is looking, right? So that's your money that you can work with at the end of the day after you've paid the bank. You can look at if you've offered a preferred return, how is it projected to do? How is the cash flow from after debt service projected to stack up against the preferred return percentage that you promised to your investors, right? Do you have enough money to cover that at the end of the day? So that's something important to keep in mind. Then you've got your typical return metrics, right? That you want to meet: your cash on cash return, your average cash on cash return, your internal rate of return, your total rate of return, right? I've got a section over here on the right hand side for kind of just zeroing in on your exit year returns. And then I usually add some more pictures of the property just in case I'm using this for a presentation or part of the pitch deck. So this is for the total property, right? This is what the total property would make if you owned 100% of it, right? So that's the total property section, and that's at the top of the file. Now, for the splits between the investors and managers, the next two sections cover that. So you'll be able to see for your investors, what is your cash on cash return, average cash on cash return, internal rate of return, and total rate of return. You'll be able to see what those look like for your investors specifically, right? So this is what you're going to be able to promise to them at the end of the day for investing in your deal, right? So these are the metrics that you're going to get to be pretty attractive for your investors. And then you've got your manager returns, right? So what is the general partners, what are they going to make out of the deal? So this breaks it down. You got your asset management fee, your acquisition fee, your excess cash flow, right? So once you've paid off any preferred returns, how much money is left over to distribute to managers? You've got your proceeds from the sale or refinance, right? So once you sell the property, there'll be a big chunk of money coming to managers as well. and you've got your total manager return. So this is the summation of all of those pieces. And you can even input, if you own a percentage, right? So obviously a lot of the general partnerships are split up and different parties own different percentages, right? So if you want to know exactly how much you're going to have, if you've got a set percentage of the manager returns, you would enter your ownership percentage down here, and it would calculate what your piece of the pie is. So that's kind of how you go through the template. We're going to be doing a lot more sections on actually inputting data in there, but want to just kind of cover the basics here. So when you start looking at the template, pulling up the Excel file, you'll be able to kind of navigate it pretty well. So this was just to get you to that phase.